Well, last week was a tough one for housing market data amid rising mortgage rates and recession fears. We saw builder sentiment for single-family homes slump, and another key survey showed home builder cancellation rates doubling since April. So, are we in a housing recession? Joining us now is Christopher Meyer, Paul Milstein, professor of real estate at the Columbia Business School. Great to have you on the program today. Christopher, tell us about kind of how you're viewing the housing market dynamics right now. Supply, if it's coming down, might mean that prices would remain elevated despite some of the steam that we've seen taken out broadly.
Yeah. Hey, Brian, thanks for having me. I would say first, it's definitely going to take, the rising rates are taking a lot of the steam out of the housing market. There may be a little bit of steam left, but not a lot. So I do think we are going to see, and we're already seeing, home prices slow, the growth to near zero across the country. And in some of the hotter markets, we're starting to see prices fall a little bit, which is not surprising given what we saw over the previous couple of years.
Now, at the same time, all of those things might point to a slowdown in the housing market, but a lot of people who are wondering, is this going to bring the affordability of homes down to a level where I can actually get into the market here? How does this compare to what we've seen in previous cycles? Because it seems like, by and large, you're still seeing a relatively hot housing market, depending on where specifically geographically you might be looking, right?
Right. So from an affordability perspective, this might be almost the worst time you could buy because mortgage rates have spiked quite a bit. We're back at the level they were, in 2009. So we're talking 13 years ago was the last time mortgage rates were this high. But at the same time, home prices and sellers are still hoping to get for their home what they would have gotten 3 or 6 months ago. And so, as a buyer, part of the reason you're seeing contracts cancel and, homes sitting on the market, starting to sit a lot longer is buyers are looking at this and saying, well, at these rates, I don't want to pay these prices or I can't afford to pay these prices. And sellers are still sticking. And that makes it a tough time to be a buyer right now.
Now, how about for a renter? Because we've seen anecdotes. I mean, we're both in New York City, and we don't need to talk to too many people to realize just how brutal it is out there to rent. How do the higher mortgage rates and the state of the housing market also bleed into the dynamics that we're seeing for people that don't have the capital to buy a house at all and don't have any other choice but to rent?
So I think the housing market is really segmented quite a bit from the rental market. So people who are looking for houses or, for apartments to rent in New York, interest rates, movements in the housing market aren't impacting them at all. But I will say that for, some of the same reasons we're seeing the economy slow down, we've seen, households under a lot of pressure because, oil prices have gone up a lot, even if they kind of started to come in a bit, food, other parts of inflation are high. We're definitely seeing sort of demand for rents start to soften a little bit. So it's not saying that rents are going to fall anytime soon. But it does suggest that I think rental growth rates are also starting to slow for some of the same reasons that we're seeing the housing market also start to slow.
Now, kind of shifting back to the housing market itself, are you seeing any sort of, obviously demand still remains strong, but, one interesting thread that we have been talking about through the post-pandemic period was the inclusion of a lot of institutional buyers, right? A lot of attention, for example, on BlackRock going into some neighborhoods and then snatching up properties. Is that still something that you're observing here? What's the scale of that? How significant is it?
There were markets where 30, 35%, even 40% of home purchases were being done by investors, some of whom were looking to rent, many of whom were just looking to flip, so-called iBuyers in the market. I think those people are going to have a lot of trouble. Even during the best of times, iBuyers were barely able to make a buck when home prices were going up 15% a year or more. And I think those buyers are going to have houses on the market that are going to be, coming back at a discount. So I do think some of those institutional buyers are going to face challenges in the market, trying to get rid of them. but I don't think that's going to make it a buyer's market from from a homeowner, from somebody aspiring homeowner perspective, because they're still facing, really high mortgage rates relative to what they were before. So net, I think that it's just going to be a tough market for almost anybody who's looking to sell right now. But it's also a tough market for people looking to buy, which is, not a great time for housing.
Yeah, well, and iBuyers, we saw what happened with Zillow and Zillow Offers, a cautionary tale for sure.
Yeah.
Christopher Meyer, Paul Milstein, professor of real estate at Columbia Business School. Thanks so much for taking the time.